There's something about a dividend cut that immediately gets investors nervous. The moment you hear the words distribution reduction, the first thought that comes to mind is often very simple. Should I sell? And honestly, I understand that reaction. If you bought BIGY because you were attracted to its high level of income, seeing the distribution fall from 31.25 cents per share to 20 cents per share, paid twice a month, can feel like a major disappointment. For someone using investment income to help pay the mortgage, cover groceries, or simply create more financial breathing room in retirement, that reduction is not just a number on a screen. It can feel personal, but after looking more closely at what Evolve is actually doing, I think there is a much more interesting story underneath the headline. Because sometimes the most important question isn't, how much is this ETF paying me? The better question is, what is the ETF doing to generate that payment? And is that process sustainable? That distinction matters. And it is especially important with a strategy like BIGY, because this isn't a traditional dividend ETF, where companies simply send shareholders a portion of their earnings. BIGY is designed around a combination of large, well-known companies, covered call strategies, and leverage. The goal is to create a much higher level of cash distribution for income-focused investors. That sounds attractive, but higher income almost always comes with a trade-off. There is no magic machine on Wall Street that produces enormous income without asking you to give something up in return. And this is where the Bigy story becomes much more interesting. When Evolve launched Bigy, the fund had a much more concentrated portfolio. It leaned heavily into the Magnificent Seven, along with names like Coinbase, Strategy, and Palantir. These were some of the companies that had captured the imagination of investors during the previous market cycle. But markets don't stay in the same place forever. Leadership changes. One year, the market is obsessed with the largest technology companies. The next year, semiconductors take the lead. Then artificial intelligence becomes the dominant theme. Then capital moves into other sectors. The market has a way of reminding us that yesterday's winners don't automatically become tomorrow's winners. And that is exactly what Evolve says it has been seeing. For example, in the period discussed in the interview, its MAG 7-focused ETF gained only about 5.94%, while its broader NASDAQ technology ETF gained roughly 36.12%. That is a huge difference. It tells us something important. The technology market was becoming broader. The opportunity wasn't necessarily concentrated in the same handful of companies anymore. So Evolve started changing BIGY. The portfolio became more diversified, adding companies such as AMD, Micron, Berkshire Hathaway, Visa, Walmart, and Johnson & Johnson, while reducing the relative weight of some of the more volatile positions such as Coinbase and Strategy. And then came the distribution adjustment, from 31.25 cents to 20 cents. At first glance, that looks like bad news. But here's the part I think investors need to slow down and think about. A lower distribution target can actually give the portfolio manager more flexibility. Why? Because BIGY generates part of its income by selling covered calls. When you need to generate an extremely high amount of income, you may have to sell calls closer to the current market price. And when you sell those calls closer to the current price, you can receive more premium, but you also give up more potential upside if the underlying stocks continue climbing. It's a trade-off. Imagine you own a stock at $100. You could sell a call with a strike price around $100 and collect more premium. That premium can help fund a larger distribution. But if the stock suddenly jumps to $120, you've given away more of that upside. Now imagine you don't need quite as much option income. You may be able to sell a call farther out of the money, perhaps at $110 or $115. You collect less premium, but you leave more room for the stock to rise before the option limits your upside. That is essentially the trade-off Evolve is describing with BIGY. So maybe the real story isn't simply that BIGY is paying investors less. Maybe the real story is that Evolve is trying to change the balance between income today and growth tomorrow. And that is a decision every income investor eventually has to confront, because the highest possible yield isn't always the best outcome. If you are receiving a huge distribution every month, but your portfolio value steadily erodes, You have to ask yourself where that income is really coming from. On the other hand, if you accept a somewhat lower distribution, but give the underlying portfolio more room to participate when the market rises, you may potentially create a healthier balance between cash flow and long-term wealth. That doesn't automatically mean the Biggie decision will be successful. It doesn't mean investors should blindly hold the fund. And it certainly doesn't mean a dividend cut should be ignored. But it does mean we should look beyond the headline. Because ultimately, the real test for Biggie won't be whether it pays 31.25 cents or 20 cents. The real test will be what happens to the NAV, the total return, and the sustainability of the portfolio after this change. And that's where I believe the next chapter of the Biggie story becomes much more interesting. Because sometimes protecting the future of an investment requires giving up a little bit of what feels good today. And in investing, that may be one of the hardest lessons to accept. Now, this is where I think we need to look a little deeper into what Biggie is actually trying to accomplish. Because once you understand the mechanics behind the fund, the distribution reduction starts to look less like an isolated event and more like part of a broader strategy. Big is not simply a collection of stocks that happen to pay dividends. It is an actively managed income strategy. Evolve combines a portfolio of large, well-known companies with covered calls, and the fund can use roughly 33% leverage. That combination is what allows Biggie to target a much higher level of income than you would normally expect from a traditional basket of blue-chip stocks. But there is a price for that higher income. Leverage can amplify gains, but it can also amplify losses. Covered calls can generate option premium, but they can also limit some upside. And a very high distribution target can put pressure on the portfolio if market conditions aren't favorable. This is why I think investors should stop thinking about BIGY as simply a high dividend ETF. It is better understood as a high-income, actively managed portfolio with several moving parts. And when you have several moving parts, the environment matters. A strategy that works beautifully in one market can behave very differently in another. Think about what happened over the past year. The Magnificent Seven remain incredibly important companies, but the market began rewarding other areas of technology more aggressively. Semiconductor companies and artificial intelligence-related businesses became major sources of market leadership. That's why Evolve expanded Biggie. Instead of betting so heavily on a small group of familiar names, the portfolio now includes a broader combination of growth companies and more defensive blue-chip businesses. AMD and Micron provide exposure to the semiconductor and AI ecosystem. Visa gives exposure to the global payments network. Walmart provides a more defensive consumer component. Johnson & Johnson adds another layer of stability. Berkshire Hathaway brings a very different type of exposure through a diversified conglomerate. And the important thing here is not whether every individual stock will outperform. Nobody knows that. The point is that Evolve is trying to reduce the dependence on one narrow group of market leaders. That matters because concentration cuts both ways. When the stocks you own are the stocks everybody wants, concentration can make you look brilliant. But when those same stocks fall out of favor, concentration can become a serious weakness. And we have seen that story play out many times in financial markets. The same principle applies to Coinbase and Strategy. Both companies can offer tremendous upside during favorable crypto and Bitcoin environments, but they can also experience very significant volatility. By reducing their relative position sizes, Evolve isn't necessarily saying, we don't believe in these companies anymore. In fact, Elliot Johnson specifically explained that Evolve remains constructive on crypto assets over the long term. The message is more subtle. They're saying, we don't want the long-term sustainability of Big to depend too heavily on a handful of highly volatile positions. And that brings us back to covered calls. This is probably the most misunderstood part of the strategy. A lot of investors hear covered call ETF and assume the manager simply sells calls mechanically every week at the money. But according to Evolve, that's not how Big is being managed. The options team is actively watching the market. They look at volatility, they look at option premiums, they look at the distribution requirement, and they adjust the strikes based on the circumstances. That flexibility becomes particularly important after the distribution reduction. With a lower amount of income to fund, the portfolio doesn't need to extract as much premium from the options market. That gives the team the ability to move farther out of the money when conditions make sense, and that can potentially preserve more upside. Think about it this way. Imagine you're driving on a highway and you have two destinations. One route gets you there faster, but it has more tolls and more restrictions. The other route takes slightly longer, but gives you more flexibility along the way. A very high distribution target can be somewhat like that first route. You may get more cash today, but you can give up more potential upside. A lower target can give the portfolio more room to breathe. Of course, that doesn't guarantee better performance. Markets don't make guarantees, but it changes the balance of the strategy. And that's why I wouldn't judge this decision simply by comparing 31.25 cents with 20 cents. Instead, I would watch what happens next. Does BIGY's NAV become more resilient? Does the fund participate more effectively when the underlying stocks rise? Does the distribution remain sustainable? And most importantly, what does the total return look like over a full market cycle? Because this is where income investing can become psychologically difficult. Investors naturally focus on the cash hitting their account, and there's nothing wrong with that. Cash flow matters. But if you're receiving $1,000 in distributions while your underlying investment loses significantly more than $1,000 in value, the headline income number can create a false sense of security. This is why I always believe income investors should watch three things together: cash flow, NAV, total return. You need all three pieces of the puzzle, and this becomes even more important with leveraged covered call strategies. The 33% leverage can work in your favor when the portfolio performs well. But if the underlying holdings fall sharply, leverage can make the decline more painful. So BIGY isn't something I would view as a simple substitute for a savings account or a traditional dividend portfolio. It is a specialized income strategy, and specialized strategies require investors to understand the engine underneath the hood. Now let's talk about another important piece of this story: Easy. Easy is essentially an all-in-one structure that holds approximately 45% BGY, 30% Caney, and 25% INI. Because Bigy is such a significant part of Easy, when Bigy's distribution was reduced, Easy's distribution also had to come down. It moved from approximately 31 cents to 25.12 cents, paid twice per month. But notice something important. CANY and INI were not affected by this change. This is a perfect example of why investors need to understand what sits underneath an ETF. Sometimes you can own one ticker symbol and actually have exposure to several different strategies underneath it. Evolve has also increased transparency around Easy by showing investors more of the underlying holdings. And I think that is a positive development. Transparency matters. If you're putting your hard-earned money into an investment, you should be able to understand what you actually own. Now, there's another development from Evolve that I think deserves attention, and that is TECY. If BIGY is designed for investors who want diversified large-cap exposure combined with covered call income, TECY takes a much more aggressive approach toward technology. Think of the evolution like this. You have QQT, which focuses specifically on the technology companies within the NASDAQ 100. Then you have QQQY, which adds a covered call strategy to generate income. And now TECY adds leverage on top of that structure with leverage of up to approximately 33%. So you're effectively combining technology exposure, covered call income, and leverage. That can be extremely attractive during a strong technology bull market, but it can also be extremely volatile. And that is an important distinction. A higher yield doesn't magically remove market risk. Sometimes it simply changes the form that risk takes. That's why I believe the most important question for investors isn't which ETF has the biggest yield. The better question is, which combination of income, growth potential, volatility, and risk can I realistically live with for the next 5 or 10 years? Because investing is not just about maximizing returns. It's about building a strategy you can actually stick with when markets become uncomfortable. And finally, Evolve has introduced another family situation that moves completely different set of opportunities. Camo. What matters isn't where you are today. Global defense what matters is whether you choose to start building your future today outside the United States. You don't need to invest tens of thousands of dollars overnight. Relatively straightforward. You don't need to become a stock market expert. Around the world has been increasing. And you certainly don't need to predict where the economy will be next year. What you need is a clear plan. a consistent investment strategy, and enough patience to let time do the rest. Because real wealth is rarely created overnight. It's built through smart decisions repeated consistently over decades.
Whether that thesis ultimately
There's a
works
quote
is
I've
something
always
the
loved.
market will decide.
People tend to
does show us
overestimate
something
what they
about
can
Evolve's
accomplish in
broader
1 year,
strategy.
but
They're not
underestimate
simply
what
building
they can
products
achieve in
around
20
whatever
years.
is popular today.
That's the power of time.
They're trying to create
and it's
different
also the
tools
power of
for different
persistence.
investor objectives.
Maybe your investment
and that brings us
portfolio is
back
still
to
small today.
BIGY.
Maybe $1 million
distribution
still feels
reduction
like
may
a
be
distant
frustrating,
dream.
But
But
perhaps
one day
the
when
more
you look
important
back,
question is
you'll
whether
realize
Evolve
that
has
the
made
hardest part
BIGY
wasn't earning the
a
first
stronger
million.
portfolio.
The
because
hardest
of it.
part was having the
If a lower
courage to begin
distribution
before
allows
you
the
could
fund
see the
to preserve
results.
more upside,
If you start today,
reduce pressure
your
on the
future
portfolio,
self will thank
and
you.
improve long-term
But if you keep
sustainability,
waiting for the perfect
then the
time,
reduction could
there's a
ultimately
good
prove
chance
to be
you'll
a
still be
reasonable
standing in
trade-off.
the same place
But we don't
years
know
from
that
now.
yet.
Time will
market
pass
hasn't
whether you
finished
invest or
writing this
not.
chapter.
The only
And that's
question
why,
is
in
this:
my view,
as time
investors should
passes,
watch what happens
will your
to
money
BIGY's
quietly be working
NAV
for you,
and total
or will
return
you
from
still
this
be
point
trading your
forward.
time for money
The
every single
dividend
day?
headline is immediate.
That choice
The
has
real answer
never
will
belonged
take
to the
time.
market.
So
It has
where does
always
all of
belonged
this
to
leave
you.
us with BIGY?
Thank you for spending your time
After
with me
looking at the
and watching
distribution
all the way to
reduction,
the end.
the portfolio
If you found
changes,
today's discussion
the covered
valuable
call
and you'd
strategy,
like to keep learning
and the
about
use of
investing,
leverage,
financial
I think there is a
freedom,
much more
and building
balanced
lasting
way
wealth,
to look
be
at this
sure to
situation.
like this
Yes,
video and
the
subscribe to the
distribution
channel
has
so
been
you don't
reduced.
miss future
That is
episodes.
a real change.
Every week, we'll
Going
explore
from
time-tested financial
31.25
principles,
cents to
break
20
down the
cents per
economic
share,
trends that matter
paid
most,
twice a month,
and learn
means
how to make money
investors who
work
were
for our
relying
lives
on big for
instead
a
of
certain
spending our
level of
lives
cash
working for
flow
money.
will receive
Until
less
next time,
income going forward.
take care.
There is
Keep
no
investing
reason
in
to
your
pretend
future,
otherwise.
and I'll
But
see
a
you in the
lower
next video.
distribution doesn't automatically mean a worse investment. And that's an important distinction. Sometimes investors become so focused on the size of the monthly or semi-monthly payment that they forget to ask where that payment comes from. A distribution is only one part of the investment equation. The other parts are the value of the portfolio, the growth of the underlying assets, the cost of generating that income, and ultimately the total return that reaches the investor over time. That's why I think the next several months will be much more important than the announcement itself. We need to watch BIGY, watch the NAV, watch how the new, more diversified portfolio performs, watch how the covered call strategy behaves, and watch whether the lower distribution gives the fund more room to participate when the market moves higher. Because if the strategy works as Evolve expects, investors could eventually discover that receiving a little less cash today doesn't necessarily mean ending up with less wealth tomorrow. And that is a lesson that goes far beyond BIGY. It applies to almost every income strategy. There is a temptation in investing to chase the biggest number on the screen. If one ETF offers a 10% yield and another offers 20%, the 20% immediately looks more attractive. But investing isn't a beauty contest where the highest number wins. A higher yield can come with higher volatility, greater leverage, more aggressive option strategies, reduced upside participation, or greater pressure on the underlying portfolio. The real question is not how much does it pay? The real question is, how much am I keeping after everything is taken into account? That is why total return matters. Imagine two investors. Investor A receives $20,000 a year in distributions, but the value of the portfolio falls by $25,000. Investor B receives only $12,000 in distributions, but the portfolio grows by $20,000. If you only look at the income, investor A appears to be winning. But when you look at the entire picture, the answer may be very different. This is why I would encourage BIGY investors not to make a decision based solely on the distribution cut. Instead, give the strategy time to prove itself. Ask whether the new structure is working. Ask whether diversification is helping. Ask whether the fund is participating more effectively in market upside. And ask whether the distribution remains sustainable under different market conditions. Evolve has also made it clear that distributions are reviewed regularly. They are not necessarily locked at one number forever. We've already seen Evolve increase distributions on another ultra-yield ETF when market conditions supported it. That tells us something important. The distribution is not necessarily the destination. It is a variable that can change as the market changes. And perhaps that is actually a healthier way to think about income investing.
Instead of expecting the market to give us the same amount of money every month, regardless of what happens, we recognize that markets move in cycles. Volatility changes, option premiums change, stock prices change, economic conditions change, and a responsible portfolio strategy has to adapt. Of course, that doesn't mean BIGY is right for everyone. If you need extremely predictable income and cannot tolerate meaningful volatility, a leverage covered call ETF may not be the right tool. If you're comfortable with market fluctuations and you're specifically looking for enhanced income while accepting the trade-offs involved, then BIGY may deserve a closer look. But the decision should come from understanding the strategy, not simply from seeing a large yield number. And that's probably the biggest takeaway I have from this entire conversation. Investing is rarely about finding the perfect product. It's about understanding the trade-offs well enough to choose something that fits your own financial life. Because at the end of the day, a portfolio isn't just a collection of ticker symbols. It's connected to someone's retirement, someone's mortgage, someone's savings, someone's plans for the next 10 or 20 years. And when you look at investing through that lens, sustainability becomes much more important than chasing the biggest possible distribution today. So for BIGY, I wouldn't call this story finished. I would call it a reset. A reset from an extremely aggressive distribution target toward what Evolve believes is a more sustainable balance between income and market participation. Whether that decision ultimately works will be determined by the numbers, not by the headline, not by the emotions surrounding a dividend cut, and not by a single month's distribution. The numbers that matter are going to be the NAV, the total return, the sustainability of the distributions, and how the fund behaves through different market environments. And perhaps that's the most important lesson for all of us as investors. Sometimes the investment decision that looks disappointing in the short term can be the decision that protects your long-term future, and sometimes the opposite is true. That's why we don't invest based on headlines. We invest based on evidence. So if you're holding BIGY, I'd love to hear your perspective. Do you think reducing the distribution from 31.25 cents to 20 cents is a smart move for the long-term health of the fund? Or do you believe Evolve should have maintained the higher distribution? And if you're not a BIGY investor, would this change make you more interested in the ETF or less? Let me know in the comments. And if you found this analysis useful, consider subscribing to the channel. We're going to continue looking beyond the headlines and breaking down the numbers behind income ETFs, dividends, passive income, and the strategies investors are using to build long-term wealth. Because the goal isn't simply to receive more money this month. The goal is to build a portfolio that can continue working for you years from now. And sometimes that means being willing to accept a little less today in exchange for giving your investments more room to grow tomorrow. Thanks for watching, and I'll see you in the next video.